Good morning and welcome to this Monday, August 10th, 2020 edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, looking at the action on Friday, we're going to get into that in just a couple minutes, but the market held up pretty well. The NASDAQ struggled a little bit, but the relative strength in some of the other areas certainly improved, and I think that's overall a pretty good thing for the market. I'm looking for, I know it's August and September tend to be kind of rough 2-month period, but they don't always go down. We need to be aware of the historical tendency. That's not typically 2 months where we would see the market flying to the upside, but 2020 hasn't been a typical year, and certainly the other months of the year have not been ordinary. And so we'll sit back and kind of watch and see what happens, transpires here over the next couple of months. The one thing I'll say is I remain steadfastly bullish. I believe the stock market's going a lot higher. I've clung to the theory that we were in a secular bull market, even in the depths of those lows back in March. I wrote about it at the time. It's not like I'm just talking about it now. I mean, I wrote about it back in March. And, we've rebounded probably faster than I thought we would. I was thinking maybe 1987 might be more of a guide where we went down and came back up a little more steadily rather than just, real quick V-shaped bottom. But I did expect we were going to come back with a vengeance because the virus, while, a major health scare and a major health issue, from a stock market perspective, stock market looks ahead. So the stock market's looking beyond, what we're looking at right now in the market. It doesn't care what's happening now. It certainly doesn't care what happened 3 months ago. Stock market's worried about what's happening in the future. What's likely to take place over the next 6, 9, 12 months and beyond. And I think that's what gets the market and investors excited. And it's what a lot of folks, I don't think, that watch the market understand, because they're looking at the here and now, the news and so forth. The market's looking way past today's news. I'm going to get into all of that though in just a minute. I do want to mention before we get started, this is a huge day for us at EarningsBeats.com. And I'll tell you a couple of things, that are coming up. Later today, here I'm over at EarningsBeats right now, and later today we are going to have an event. It's open to the public. It's free. Anybody can come in. The only thing is, we want you to be part of our community. So you don't necessarily need to be a paid member, but you do need to at least be a subscriber to our free EarningsBeats Digest newsletter. All you have to do is go in to EarningsBeats.com, sign in with your name and email address, subscribe. And I'm sure we'll put up the room later on the site. If you sign in and you're not a part of our community, we'll add you based on the information that you provide us. But to be added to the free newsletter, there's no credit card required, nothing like that. You can unsubscribe at any time, but you do need to be at least a free EarningsBeats Digest subscriber in order to attend tonight's top 10 stocks sneak preview. And the top 10 stocks refers to the 10 stocks that go in each of our portfolios. That event will be Wednesday, August 19th. So that's coming up in 9 days. Can't believe 9 days away, another quarter behind us. But if you go over and look at these portfolios, you can see how they've done since inception versus the S&P 500, and also how they've performed this quarter versus the S&P 500. And I think you'll see that our portfolios have done very well over time. The income portfolio is still down to the S&P 500 since its inception, down a little bit this quarter. But the other three have done extremely well, and pretty proud of the performance there. But I'm going to talk tonight at the event, the sneak preview event. I'm going to be talking about how we put together these portfolios. So even if you're not a member of EarningsBeats and you're not here to get the actual portfolios, you'll get a pretty good idea tonight as to how we put these portfolios together, what we look for, the combination of fundamentals and technical information that we just commingle in order to come up with what we believe are the best stocks for the next 90 days. And, these portfolios, I know that a lot of our members use them in some fashion. I use them pretty, regularly. I don't put my money in the portfolio and just let it sit. I'm a trader at heart. I tried that one quarter actually, and it's just not my style. My style is to trade. These portfolios were developed for a lot of our members that don't have time to trade. They don't want to be sitting at their computer. They don't want to make 10 trades during the day, or even swing trade, short-term swing trade. They're working. They want their money to work for them. They like what we talk about at EarningsBeats, but they just don't have time to sit at their computer and make trades. That's what really these portfolios were designed for. And so we don't put stops in. It's really a combination, if you can kind of imagine, it's a marrying of buy and hold and trade. We trade, but we trade once every quarter. So that's the top 10 stocks. Once we announce the top 10 stocks, they go in the portfolios and you don't do anything with them for 3 months. Up, down, they go up 50%, 100%, down 40%, doesn't matter. You're holding 10 stocks for 90 days. And we've had members write to us and say, well, why don't we have stops? We should have stops. They're not trading. I mean, think about what buy and hold means. Buy and hold means you don't have stops. You buy and you hold. Now, the difference is between the true buy and hold is you're only buying and holding for 90 days. And then you're going to put another 10 stocks in. But if you look at the model portfolio, since our inception, we're now up 118%. S&P 500 is up 24.5%. That's a lot of outperformance. I'm not really interested in doing a whole lot of tweaking, to be honest. I think it's working. Why would anybody change? Why would we change anything we're doing with those results? But anyway, I'm going to get into all of that later today, 4:30 Eastern. Make sure you come to EarningsBeats.com, sign up for our EarningsBeats Digest newsletter. And like I said, if you come in around 4 o'clock, I'm sure we'll have the room link up. But if you do go into the room and you're not part of our community, just remember we are going to add you to our free newsletter. And that comes out Mondays, Wednesdays, and Friday mornings. And I think you'll find it very educational and helpful, and a lot of times great trade ideas. All right, let's keep moving here. I want to get through some other things. I do want to also mention, though, before we get into the market and what it did on Friday, if you go over to stock charts later this morning at 10:45, I'm actually going to do a recording at stock charts for your daily 5. So if you go to Stock Charts TV and check out the schedule today, you'll see I'm the next upcoming guest, which is today. Like I said, I'm going to be recording it near 11 o'clock, but it's going to be aired at 1 p.m. Eastern, right here. So make sure around 1 o'clock, if you'd like, you can go over to Stock Charts TV and you can check out the recording I do. I'm going to talk about a couple of the topics today, but I'm not going to go through everything. That Your Daily 5 show is just for me to kind of give 5 themes, 5 charts, kind of a thing. They do it with a lot of different guests. It's actually a pretty fun show. But that'll air at 1 o'clock, and you can check that out over at Stock Charts TV. All right, let's go back here. Actually, let's go into what happened on Friday. So the market, we've got the Dow and the S&P now. S&P's moved above those June highs very clearly, 3351. I believe our all-time high is 3393 and change. Maybe it's 3394. So we're getting very close to the all-time high. Of course, the NASDAQ's already passed its all-time high. It's been in that territory for the last couple of months. The Dow is just now trying to get through its high from June. So once it gets through that high, then we've got the all-time high back in February to deal with on the Dow, and that's up above 29,000. And I think they're all going to make it. I don't think it'll be that much longer before the Dow and S&P 500 both are in all-time record high territory. Might be a little bit longer for the mid and small cap stocks. I think they were hit a little bit harder by the virus. Many small cap companies, mid cap companies struggling to stay afloat, and their access to credit. A lot of times with smaller companies don't have a big pile of cash on hand. They do require quite a bit from financial institutions and financial institutions right now having to build their loan loss reserves it's not as easy to get loans right now. So small caps and mid caps have struggled a little bit in this environment, but they too are rebounding and they're trying to get back above those June highs. As far as the performance of individual sectors, this last week or two, we've seen a little bit more of rotation into maybe a little bit more into the value stocks, but I would just consider them the laggards, the whole pandemic laggards. Companies that have just not performed as well, sectors that have not performed as well, are starting to get a little bit more love on Wall Street. Financials on Friday went up more than 2%, utilities 1.8%, industrials 1.7%, real estate 1.4%, and then on the bottom of the totem pole on Friday, technology. If you want to know why NASDAQ didn't perform on Friday, look no further than the XLK, down 1.5%. I think the three areas that have been leading technology, computer hardware, software, and semiconductors, those three areas were all hit on Friday. And so this isn't a bad thing. I think we sometimes look and, technology is getting hit, that's bad for the market. Well, it is if the overall market and everything, when we look across the major indices, if everything's going lower and technology selling off, that's not good. But in this case, it was rotation. It was mostly money coming out of technology, money coming out of the NASDAQ and going into all these other areas. And that is the hallmark of a bull market. It's this wide participation, many of these areas that haven't participated nearly as much as the NASDAQ. When you look at this move right here, under 7,000 to above 11,000, and you look at that on a percentage basis compared to some of the other areas need to play some catch up. And I think that's what we're beginning to see. So I'm not at all upset by it. The biggest question, I mentioned the big event coming up and having to go through and restock our portfolios in 9 days. I think the biggest issue is looking ahead to try to figure out, I think everything's going to go higher. But the question is, or maybe some areas consolidate. But the bigger question is is the market going to favor these laggards, and play a little catch up, or are the technology stocks going to continue, with their rapid acceleration of growth, earnings growth? Are those companies going to be the ones continuing to lead to the upside? And that's, for me, the biggest question. I think we're going to go higher, but we're going to have to get that right, or at least partially right, in order to outperform the S&P 500. So that's going to be the battle. And of course, I'll be talking a little bit about that tonight at 4:30. And then of course, on the 19th, I'll be talking about it quite a bit more. All right, so that's your recap. The 10-year Treasury yield, first of all, no economic reports out today. So we don't really have the market looking at the economy, at least not specifically at any one report or a couple of reports today. And currently we do see, or at least we were down a little bit. We're down a little over 1 basis point, 0.55%. I'd really like to see this move back up above the 20-day and start trending higher. That would be the indication that, really the stock market is on real solid footing. It's already on solid footing. I don't want to make it sound like it's not on solid footing, but if you study history, that some of the bigger advances in the stock market occur when money is rotating out of treasuries. And when money is rotating out of treasuries, the yield goes higher, always. When the treasuries are selling off, yields go up. Prices go down, yields go up. Never a question about that. 100% inverse correlation. That's how the bond market works. So I like to see the 10-year Treasury yield moving up. Now, normally, if you're in a bad market, if you're in a bear market and yields are going down, money's going into treasuries, it's almost always from money coming from the stock market. Rotation, out of stocks into bonds. That is the definition of a bear market, when you see that kind of massive rotation. That's not what's happening here. Yeah, money is going into treasuries, but it's not money coming out of the stock market. It's money coming from the sidelines that's been sitting in cash that wants to put something to work, but isn't quite sure where to go. So they're picking bonds over stocks, which I think is a mistake, but there's a lot of folks looking for safety. And I think once this economy really turns and we start to see some of the other areas of the market performing well and growing their earnings, I think you're going to see a flood of money rotating out of bonds and into stocks. And that, I think, is going to be the fuel for a major stock market advance. And I know some of you might say, well, we already had a major stock market advance. No, we didn't. We simply, I mean, some stocks had a major advance. Look at the S&P 500. Let me pull up the S&P 500 for you. I'll show you where we were in February. We were just under 3,400. Where are we now? 3,350. Where's the major advance? I mean, is the major advance here? Well, that's because everybody panicked out of a market they shouldn't have panicked out of. A lot of money left the market. The market discounted. You know, we were heading for the next Great Depression. Well, here we are. We're not in the next Great Depression. Market's just kind of come back to where we were. I said going into this year, the S&P 500 would finish this year above 4,000. And wasn't feeling very good after the pandemic hit. We were down at 2,200. But, you know, 4,000 is still possible at this point, even with a pandemic. And I think absolutely, if we didn't have the pandemic, we might already be at 4,000. I think the stock market's going higher. The other thing that we have to watch with yields, and I bring this up a lot, and I just always want to keep bringing it up because it's something you should be looking at relatively regularly, and that is our Treasury yield in the US versus Germany's. I see the correlation between the US and Germany stronger than probably any other two countries in terms of the currencies. You know, when we're looking at the dollar versus the euro, when we're looking at equity prices and performance, Germany and the US tend to, I think it's important to follow along with what's going on in the US versus in Germany. And one of the things that we've seen and that I like to watch is the relationship of the Treasury yield in the US versus the Treasury yield in Germany, the 10-year Treasuries. And we were seeing that rise in the US versus Germany much faster, or the relative. This doesn't mean that the yields were going up. This just means that maybe the yield in the US was going down, but not as fast as Germany's yield. So the difference was actually widening, and that's what sends this higher, okay? Now, when we come back the other way, and by the way, when you're seeing the yield going up in the US faster than Germany, or when it's going down but less fast than it was in Germany, it's telling us that our economy is stronger. That's, you know, if you look at the bond markets in both countries, the reason people get in and out of the bond market is a lot of times based on what's going on in the economy. So when the economy is stronger in the US than Germany, we should expect this. But when the market starts to believe Germany's economy could be stronger, then we see this. And when Germany's economy is stronger, we should be seeing the dollar move lower and the euro moving higher. And so on this chart, I just have the dollar index. But while our yields in the US were going up faster than Germany's, or going down less fast, you can see the dollar rising along with it. But there are periods where we move up in the move up in the yield versus Germany, the dollar moves down, and that creates an inverse correlation. And then the dollar plays catch up. Moves up, dollar moves down, inverse correlation, we play catch up. We move down, here we actually move up in this, 6, 7, 8 month period. The dollar index keeps moving down, inverse correlation, dollar plays catch up. Well, now we're going the other way. The yield's going down, the dollar's going up, inverse correlation, the dollar's playing catch up, but this time to the downside. And we broke this trend line. This is kind of an important deal when you break a 9-year trend line. That doesn't mean that the dollar is just going to fall apart and go straight down, but I do think in time we could see the dollar index move back down into the upper 80s to test this low. We have a higher high here. So while the trend line could break, I don't know that the long term, if we break below 88 on the index, then I don't think there's much question in my mind that the dollar would probably in a longer term downtrend. Right now, I think we've gone from a short term downtrend to an intermediate term downtrend in the dollar. And that could set up nicely for materials and possibly energy. But I'm also watching this right here, this sideways consolidation, because if the Treasury yield in the US turns back up versus Germany, that would mean that the bond market here is suggesting our economy is strengthening, maybe better, faster than Germany's. And then I think in the near term, we could see a little pop in the dollar. But I do think based on everything I'm seeing right now, and technical analysis is really just putting everything that you see now together and making a call. And then if as conditions change, you have to go back and maybe revise that. It's kind of like, looking at a hurricane coming down, in the Atlantic toward the East Coast and trying to predict it 10 days in advance. Well, after 5 more days, you have more data. So while, your forecast and your model may have thought that it was going to turn up, north before it hits the US 10 days before, 5 days before, now you have new information and you can revise your forecast. That's really technical analysis. Now, a lot of people look at that and say, well, that means it's worthless, because if you keep changing your mind, it doesn't mean anything. Well, that's not true. And you can definitely, I use technical analysis to reduce my risk. I don't use it for a guarantee. I use it to reduce my risk. So as long as the dollar was uptrending, I had no interest in materials. And, there's some that say, well, you haven't been, in on this materials party for the last few months. Well, yeah, but I wasn't in on the whole decline for 9 years either while the dollar was going up. I stayed away from that area. When we get a confirmed downtrend that lasts for more than just a short term, then yeah, I think the materials group could produce some really nice opportunities. If the dollar keeps going down, we're not done with materials advancing. And I think with the overall market going higher, materials are going to go up anyway. The real question is, are they going to outperform the S&P? That's what I'm more concerned about. I think materials are going higher. I think material stocks are going higher, and I've never said otherwise. But will they outperform the S&P 500? Because that's where I'm really focusing my interest. I'm looking for where we're going to see outperformance. All right, let's move on. How about transportation average? Look at this breakout on Friday. See that June top? Last 3 days of last week, saw the volume picking up, broke through that resistance. I think transports look really good at this point. Now could we pull back? Sure, we're well above that 20-day moving average, but if we get a 20-day test, I'd be a big buyer of transportation stocks. All right, next up, let's go to the delivery services group. I mean, if you're looking for a group that has really taken over in terms of leadership, it's the delivery services group. And if I pull up this is another thing I'll be talking about tonight, because this is a big part of putting together these portfolios. I use this, relative strength chart list that I have of industry groups to see which areas are really strengthening and which areas remain very strong, because they're the ones most likely to be strong for the next 3 months. And if you go down here to the delivery services group relative to the S&P, see how it's been in this downtrend for a long time? I think you can see right here that is behind us. And so, this is an area we saw UPS and FedEx both come out with incredibly strong results and big reversals and moves to the upside, breaking out, both of them. And so that's an area that's really got my interest for sure. Now, which one's better, UPS, FedEx? I don't know, maybe I might talk about that a little bit tonight. I'll definitely talk about it for the portfolios if I decide to go with one or the other, or maybe both, who knows? But yeah, this is a group that's done extremely well. And so UPS and FedEx will be areas to think about. Now, one other thing I wanted to show you with our chart list, and I think this is a really cool feature. We've got our chart lists that any of our members at EarningsBeats, our paid members, we send them our chart list if they're also at least extra members over at Stock Charts, and they can download them into their account. Now, if you're not a member at Stock Charts, or if you're just a basic member, you can still see all the stocks on our chart list. You just can't download them. If you're not a member, obviously you can't download them because you don't have an account. And if you're a basic member, the problem is you can only have one chart list, which is given to you when you first start it up. So you don't have room to download more chart lists. That's why I think it would behoove you to make sure you're at least an extra member over there. But what you can do with our chart list, watch this new scan that I'm going to show you. And I'm going to do some more of this on Saturday. I'm going to go ahead and just tell you, we've got another free event coming up on Saturday. We have made so many changes over the past year. And by the way, 1 year ago today is when I made my announcement that I was heading back to EarningsBeats. It was 1 year ago today, August 10th, 2019. So we've come a long way in the last year. We've added a tremendous amount of products and services. And so I'm actually going to have a free event on Saturday just to, I mean, I think it'll be beneficial for both members and non-members. Members, you know, we've gotten so many things, we've been doing so many things, added so many features that we're getting a lot of questions from members. You know, what's the best way to use this chart list? What's the best thing to do with, you know, how do you use short squeeze chart list? All of those things are going to be discussed in Saturday's event. So mark your calendar. I think that'll be at 2 p.m. Eastern. But if you can't attend, and same with tonight, if you can't attend, we will still send out recordings to those in our community. That's why you want to make sure you sign up for that EarningsBeats Digest free newsletter if you're not already signed up. But anyway, let me show you, this is one thing I'll talk about on Saturday, combining chart lists. And what I mean by that is you can take two chart lists. So let's say, you know, you're looking at the short squeeze chart list. And this chart list we give to our members, which tells everyone, okay, here are the companies that have at least 20% of their float short. What it means is that there are a lot of people betting against the company and have short positions. And if you're not familiar, when you sell short, you're selling borrowed shares. You have to buy them back at some point down the road and return them to your broker. So you don't own the stock. I mean, you can't sell something you don't own, but you can sell something that you've borrowed. And so think about it this way. You know, your next door neighbor's got this Lamborghini and you think the value of Lamborghini is going to go down. So you ask him, do you mind if I borrow your car for a while? And he's like, well, this is a really nice neighbor. But the nice neighbor says, sure, go ahead, here are the keys. So he's borrowing the car. Now the reason, he didn't tell the neighbor why he's borrowing the car, but he's going to borrow the car because he thinks the value of Lamborghini is going to go down. And so he sells the car. All right, bear with me. I know he doesn't have the title, but just in theory, he sells the car. A month later, the value of the car has gone down $20,000. He buys it back. So now he bought it $20,000 cheaper than he sold it. He just booked $20,000, and now he returns the car back to his neighbor. That's all you're doing in the stock market when you sell short. You're borrowing from your broker shares that you're going to sell, but you have to buy them back at some point so you can return them to the broker. All right, so there's your short squeeze chart list. Now, most stocks on this chart list are not good stocks. These are companies that the market is betting against, and many for good reason. But as stocks, you know, start to report better earnings, and they start to, you know, turn their prospects around, they could be breaking out. These are short squeeze stocks that could be breaking out. Now, the only stocks on the strong earnings chart list are stocks that have beaten revenue and EPS estimates, you know, Wall Street's estimates of both revenue and earnings. So they've beaten that in their last quarter. They also look good on their charts technically, and they're liquid, meaning that they've traded at least, you know, maybe 200, 250,000 shares daily over the past, I don't know, 50, 90, 100 days, whatever. But here's your two chart lists. Now, what you can do at stock charts is you can take this and essentially, if there are any stocks that are on both of these lists, they'll be given to you. So I can check the syntax, make sure that this works. Okay, scan syntax is correct. And now I run the scan. There are 4 stocks that are on both the short squeeze chart list and the strong earnings chart list. These are 4 stocks that I would be very interested. By the way, this is a stock, Rite Aid, that I wrote about in the EarningsBeats Digest for everybody this morning. Here was the big move up with earnings, gapped up to 14.49, ran to 18 and change, and it's come all the way back down, and it's near this area, which doesn't mean that the stock's necessarily going to go higher. It doesn't mean it has to, but your reward to risk is going to be pretty solid at this level. So that's just one of the things that I'll be talking about on Saturday. So again, a couple big webinars coming up Monday and Saturday that will hopefully show you a little bit about what we do at EarningsBeats and what we've put together over the last year. I think it's a great platform. A lot of research, a lot of work's gone into it, and our members are benefiting from it. All right, let's move on. I want to talk a little bit about earnings. And I know it's 9:30, so we're going to just talk about a couple of these. Duke Energy reported. Let me just go over here and pull up the, see, oh, I don't even need to do that because now the market's open, so I can see what the market's reaction at the open is. All right, stock's up a little bit. Duke did beat on their bottom line, $1.08 versus $1.04. And if we pull this up on a relative chart, I mean, you can see that this is not a good group. You know, multi-utilities, definitely not a good group relative to the S&P 500. And the stock's been pulling back on a relative basis for almost 2 months now. So this isn't going to be something I'd be interested in. Earnings, yeah, we got a nice little pop, very slight, but we are up at least, which is better than the alternative. But this is not a stock that I'm overly excited about. How about Mercado Libre and Meli? Well, this one gapped up. And if you go down here, now this one does look pretty good. You've got its peer group breaking out on a relative basis to what looks like about a 9-month high. And the stock relative to its peers and relative to the S&P both look good. Now, the stock's been moving up. It was anticipating good results. The results were very impressive. Earnings were expected to be 10 cents. They came in at $1.11. So we get the big move up, $45 up right now. But a lot of this was priced in. So a lot of times you see the gap up and then you see the reaction to the downside during the day. I would be using that as an opportunity to get into a stock like this. Now, I'm not saying because it's come down, $30 from the open. I'm just saying this would go on the strong earnings chart list for sure. And then we'll wait. Maybe we get a 20-day test. Maybe we come down here and test this price support all the way down at 10.50. It happens, believe me. Many times it happens. You know, after Tesla reported, you can see Tesla pulling back and consolidating. I think the same thing could happen with a stock like Meli. How about Marriott? You know, this was going to be an interesting morning because I knew there were going to be some bad reports coming out. And I was interested to see how the market would react. Because if you get some of the worst fundamental reports coming out in some of the worst performing areas of the market, and the market shrugs it off and says, yeah, we'll still go up, I think that's a pretty good indication that a lot of bad stuff is built in. Marriott reported a loss of 64 cents. The market was looking for a loss of 44 cents. So it was almost 50% higher than what was anticipated. And right now the stock's up almost 1%. That kind of gives you a little clue. Now it's up more than 1%. It's actually rising. Now, would I be jumping into Marriott? No. It's one of the worst performing hotel stocks. Hotels have been moving down. But this, I think, is a good indication for the market because even the companies that were beaten up are not good performers, reporting bad results, and the reaction is positive. I think that's good. How about Royal Caribbean Cruise Lines? The stock right now is flat. They were expected to lose $4.71. They lost $6.13, and the stock's down 2 pennies. Now, I got to admit, cruise lines and airlines are two that I have no interest in. Royal, though, is one of the best stocks within the recreational services areas of the market, or area of the market. So you've got, one of the best performers among its peers, but its peers just are not very good relative to the S&P. There's nothing on this chart that makes me want to jump into Royal Caribbean, but I'm still pulling for the company to do well because I want these bearish areas of the market to still remain in an uptrend. I didn't want this company to go back and fall below 45. I mean, some companies won't participate, but most will, secular bull market. So I just want the stock to continue to stabilize, maybe make some positive ground somewhere down the road. Another company, I think this is one that's heavily shorted, SDGR, if I'm not mistaken. They came out, they had a pretty big number, pretty big beat. The expectation was a loss of 25 cents. They only lost a nickel, but the stock is still not going up even with that news. And you can see it's in the software space, and it was doing pretty well versus software until the beginning of July, but now it's pulled back. And earnings, if anything, should be the catalyst. I would watch this one unless it can break above that 20-day moving average. I think I'd look for another software stock, even with the solid earnings. Next up, last one I want to look at is Momenta Pharmaceuticals, MNTA. This has been one of the best performers, and the stock actually missed its estimate. Supposed to lose 42 cents, it lost 48 cents. And it also, speaking of losses, topped on a relative basis versus the biotechs probably 6-7 weeks ago, and it's been downtrending and not getting a very positive reaction to its earnings. So still got some pretty good support on the stock down around the 28, 29 area, but I think that's probably where we're heading, and we'll see whether or not we hold. All right, let's wrap this thing up with the 3 you must see. I'm going to go with 3 companies that really have not been performing well, especially 2 of them recently. And the first one is Goldman Sachs. Goldman Sachs is now uptrending nicely off of this recent low. Here was earnings. I was talking about companies that post great earnings, get this big gap up, and then pull back for a while. Well, here's a poster child, Goldman Sachs. I actually tried to trade this off the 20-day. I thought it was going to bounce off the 20-day, ended up getting stopped out. But Goldman Sachs at 220, well, I guess it was 225, went all the way back down to about 196, and now is turning back to the upside. Higher lows still in place. Had a higher high here. I think we're running back up to 225. So I think Goldman Sachs is looking pretty good at this point. Watch that 20-day moving average, the downside. Second stock is AXP, American Express. Look at the breakout above these recent highs. We're moving to about a 7-month high on AXP. And this is some of that rotation I'm talking about. You know, market moved higher, but many of these companies were struggling. Now, you know, Goldman Sachs seems to be turning it around. AXP breaking out above these recent highs. And the key lows remain in place, higher lows. So I think the market still looks good, even among some of the worst looking stocks. They're not great relative performers. You can see, look at AXP versus its peers, and then also versus the S&P 500, down near 52-week lows. So is this a great company? Yes, it's a great company. Is it a great relative performer? No, it is not. So therefore, it wouldn't be high on my list, but again, it's making me feel more bullish about the market because some of our laggards are performing well. Now this one looks a little bit better to me, and this is United Health. This one we'll wrap up with. We broke out after sideways consolidating, had a lot of struggles around the 300 up to maybe about 310, 312. Well, we've cleared it. Now today we're down a fraction, but the overall trend is up. And when we look at the stock relative to its healthcare provider peers, it's trending higher and it's near a 52-week high. So this one to me looks better. I'm getting a breakout. I'm getting, you know, I've got relative strength. You know, maybe healthcare providers isn't my favorite area of the market. You come down here and you can see relative to the S&P, it's down, you know, been down about the last 4 months. But this is one of the leaders in the space, and it is getting a breakout. All right, that is it for today. I do want to again remind you that later today, we will be having that sneak preview. I don't want to, you know, beat a dead horse, but it's free. So if you're not already a member, come in and check it out. We've got great results in our portfolios, and I'm going to show you and talk to you exactly how we create these. So anyhow, that is it. Again, you can go over to EarningsBeats.com, sign in, and then sign up for our newsletter. We'd love to have you. And if you want to check out service, I don't want to discourage you. Just click on this join today, and it'll bring up the different levels of service, you know, trial, monthly, and then annual. If you do end up signing for the annual, I'll just give you a little one sneak preview of this show. We're going to have a good special tonight at the webinar. And so if you try it, get the trial, you're checking it out, you like what you hear tonight, there will be a really good deal at the webinar. So anyhow, everybody have a great rest of your day, and I'll be back later today with that sneak preview. Happy trading, everybody.